The billion-dollar pivot: should a single company run Kenya's infrastructure? Section 1. The revenue chassis, the hook. Imagine if tomorrow, the government stopped funding highways, railways, and ports through the national budget. Imagine if we took all our national assets, the SGR, our airports, our toll roads, and handed them over to a single, state-owned corporate entity. A company run not by politicians, but by investment bankers, fund managers, and civil engineers. As developing nations struggle under the weight of heavy sovereign debt and volatile finance bills, a radical structural idea is gaining traction across global financial corridors: the creation of an infrastructure asset corporation. The promise is revolutionary: run national development like a business. Keep massive project debt off the government's books, eliminate bureaucratic delays, and attract trillions in private global capital. But is transforming state infrastructure into a corporate conglomerate a silver bullet for economic growth, or is it a dangerous shortcut that opens the door to unprecedented financial scandals? In this video, we are breaking down the mechanics of the corporate infrastructure model, analyzing the pros, the cons, and the dramatic global lessons from Singapore and Malaysia to see if this pivot can rescue Kenya's economy. Section 2. The mechanics of the OFF balance sheet trick. To understand why governments love this model, we have to look at how infrastructure is traditionally funded. Under the classic model, if a ministry wants to build a bypass, the national treasury must borrow the money, add it to the national public debt, and tax the citizens to pay it back. This directly spikes the country's debt to GDP ratio and triggers fiscal panic. An infrastructure asset corporation flips the script using a financial maneuver called off-balance sheet financing. The state creates a corporate entity and endows it with existing income-generating assets, for example, the revenue from the Nairobi Expressway toll fees, the railway development levy, or port docking charges. Armed with these steady revenue streams, the company goes into the international capital markets to issue its own infrastructure bonds. Because the company is borrowing on its own balance sheet, that debt does not count as sovereign national debt. It insulates the treasury, protects the country's credit rating, and allows projects to be executed without shocking the citizen with immediate, aggressive taxes. The company builds the asset, collects the revenue, and pays off the investors directly. Section 3. The success story is Singapore's ruthless capitalism. When executed with absolute institutional discipline, this model can transform a nation. Look no further than Singapore. When they gained independence in the 1960s, they faced an existential crisis, zero infrastructure, and a bankrupt state. Instead of relying on slow ministries, they established JTC Corporation to build and manage industrial infrastructure, and later created Temasek Holdings to manage state-owned commercial entities. The secret to Singapore's success wasn't just the corporate structure, it was their ruthless corporate governance. The government established a non-negotiable rule: these companies had to operate strictly on commercial terms. There were no political appointments. If a board member mismanaged funds, they faced severe legal consequences. If an infrastructure project could not prove its long-term financial viability, the company refused to fund it. By treating state assets with the discipline of a private equity firm, Singapore attracted trillions in foreign direct investment and built a world-class industrial engine without burying its citizens in unpayable sovereign debt. Section 4. The Doomsday Scenario, Malaysia's 1MDB Trap. But if Singapore represents the dream, Malaysia represents the absolute nightmare. In 2009, Malaysia created a state-owned strategic development company called 1MDB, One Malaysia Development Berhad. The goal was noble: use a corporate vehicle to borrow billions in global capital markets to fund massive energy and infrastructure projects across the country. However, because the company operated outside the strict oversight of traditional government ministries, it created an institutional blind spot. It became a playground for unprecedented corruption. Billions of dollars intended for infrastructure projects were systematically laundered through shell companies, offshore accounts, and elite real estate portfolios, resulting in one of the largest financial scandals in human history. 1MDB accumulated over $11 billion in toxic debt. And because the corporate entity eventually collapsed, the contingent liabilities kicked in. The Malaysian government was legally forced to step in, forcing everyday taxpayers to foot the bill for decades to come. One MDB proved that when you give a state company the power to borrow billions without absolute transparency, you aren't creating a development tool, you are building a ticking financial time bomb.
Section 5, the Kenyan Roadmap, How to Make the Pivot Work. If Kenya considers consolidating its infrastructure projects under a single corporate vehicle, such as merging elements of the Kenya Urban Roads Authority, Kenya Railways, and the Kenya Ports Authority's assets, we cannot afford to get it wrong. To ensure this pivot looks like Singapore rather than Malaysia, any infrastructure company must be anchored on 3 non-negotiable legal safeguards. First, absolute legislative transparency and parliamentary veto. The company cannot operate in a legal vacuum. Every single bond issuance, asset valuation, and major international public-private partnership contract must be subjected to public participation and mandatory approval by the National Assembly. We must amend the Public Finance Management Act to ensure that the Auditor General has unrestricted, real-time access to the company's books. Second, the strict merit-based board of directors. The board of an infrastructure asset corporation cannot be used as a soft landing spot for retired politicians or loyal cronies. The board must be legally restricted to certified investment bankers, project finance experts, and international infrastructure engineers, recruited through a transparent, competitive global process. Third, a hard cap on Treasury guarantees. To protect the everyday citizen, the law must place a strict limit on the contingent liabilities the National Treasury can sign off on. If the infrastructure company wants to borrow for a project, it must do so based strictly on the commercial viability of that specific project. The central government must not offer unconditional sovereign guarantees. If the project cannot pay for itself, the company should not build it. Section 6, Conclusion and Outro. Moving infrastructure development from slow government bureaucracies into a disciplined corporate engine is a powerful macroeconomic tool. It has the potential to unlock trillions in private investment and shield our national budget from debt distress. But a corporate structure is only as honest as the institutional guards we build around it. If we bring corporate discipline to our infrastructure, we build a future. If we only bring corporate opacity, we invite a crisis. What is your take on this? Should Kenya consolidate its infrastructure assets under a single, highly scrutinized state corporation? Let's have a structured, data-driven conversation in the comments section below. If you valued this deep dive into institutional finance and want to see how it connects to our past analysis on the National Treasury crisis, devolution, and the historical Kenyan miracle, hit that subscribe button and watch the complete series right now. Thank you for watching, and I will see you in the next breakdown.